index funds, mutual funds, hedge funds, or ETF. These buzzwords are everywhere. But what do they really mean? Especially if you are investing in Indian stock markets. Hi, this is Insight Equity, and in this video, we will break down these investment options in the simplest way possible, in a way that actually makes sense for Indian retail investors. Stick around for just 10 minutes and you will learn what people take years and losses to figure out. And yes, this is not any financial advice, but just good old insight. The basic question first: what is a fund? Now imagine you and your friends are organizing an event, and instead of one person paying for everything, everyone contributes a small amount. And with that pooled money, you arrange caterers, decorators, DJs, and everyone gets to enjoy the event and celebrations instead of managing the chaos. This is exactly how the fund works. It pools money from many investors and invests in assets like gold, stocks, or bonds, managed by professionals. You don't have to worry about investing in individual stocks or bonds or assets. That is done by fund for you. Let's begin with index funds first. One of the most talked about options of investment is index funds, even in India. You might have heard someone say, invest in Nifty 50 and chill. But what does that really mean? An index fund is a type of mutual fund or ETF that simply copies the stock market index, such as Nifty 50 or Sensex. It does not try to pick winners, instead, it mirrors the top companies of the index. For example, if you invest in Nifty 50 index fund, your money will be invested in top companies of India, such as HDFC Bank, Reliance, Infosys, TCS. The weight of each company is based on its market cap. The best part of this is these are passively managed funds, means much lower fees. Sometimes it is as low as 0.1% as compared to the actively managed funds. And these are easily available from Indian AMCs like SBI, HDFC, ICICI Prudentials, and new players like Grow and Zerodha. Now let's talk about the mutual funds. Probably the most common entry point for Indian investors. These are professionally managed funds where professionals pick stocks or bonds actively, trying to beat the market. Sounds good, right? But there's a catch. The fees. Mutual fund expense ratios can go as high as 2% per year. And studies show that most actively managed funds do not even beat the market even after the fees. Investors still prefer mutual funds for their sector specific investment, such as IT, small cap, pharma, or even international themed investments. In India, most famous mutual fund houses are Mirae Assets, Nippon India, Kotak Mahindra, and Axis Mutual Funds. Here's where it gets little exclusive. Hedge funds. These are private investment funds that uses complex strategies such as derivatives, leverage, or short selling to earn high returns. But it comes with high risk and are generally open to HNIs, that is, high net worth individuals and institutional investors only. Think of hedge funds in India like Alchemy Capital, IIFL Wealth, or Old Bridge. And these hedge funds are not listed on apps like Grow or Zerodha and generally require crores to invest. Finally, the ETF or exchange traded funds. These are the most flexible option for investors who are looking for the best of both the worlds. ETFs are just like index funds, but they are traded on stock exchanges and you can buy or sell them throughout the day using your Zerodha Upstocks or any other demat account. ETFs also have low fees and give you exposure to things like Nifty 50, gold, banking, IT, or even international indices like Nasdaq 100. Examples include Nippon India ETF, Nifty Bees, Motilal Oswal Nasdaq 100 ETF, or ICICI Prudential Bharat 22 ETF. To wrap it up, if you want simplicity and low cost, go for index funds or ETFs. If you want active management, go for mutual funds, but research the fees and performance. If you are wealthy investor chasing alpha, hedge funds might be for you, but understand the risks. For most retail investors in India, starting with index funds or ETFs is a safe and a smart way to begin your investing journey. If this video gave you clarity, don't forget to like, comment, and subscribe to Insight Equity, where we break down finance for real people. Also, if you want to invest in stocks individually based on technical analysis, check out our next video on how to master trends using Supertrend and EMA.